Hello traders, we are 2.5 hours into trading. It is Monday, December 23rd. The action is really slow. You can see here that the S&P 500 has basically flatlined the last few hours. This is what we can expect. I would say that we probably will drift up to the open today. That would form a doji formation on a D1 chart, just like that bar. That's been the tendency to gap higher and then flatline. But I am doing this video as a follow-up. I want to take a look at Boeing because I did sell a bearish call spread on Boeing. We saw the stock run up. It filled in this gap right here, and then it backed off instantly. We've seen a lot of weakness in the stock, so it looked like a really nice bearish call spread to sell using that 337.50 price level. Let's go into the 5-minute chart. Let's take a look at it. So my thesis was this opening price right here failed. I shorted the stock. I ended up buying it back on that red bar right there. I did not like that long green bar closing on its high, so I took a profit on the short stock position, but I still kept on my bearish call spread. Why did you do that? Well, I sold it for $1.10 credit, and the spread is 2.5 points between the strike prices. So 2.5 minus $1.10 is $1.40. That's my maximum risk on the position. That's also what I have to put up in margin. So to make $1.10, I'm risking $1.40. So that's about a 45% chance of losing. Excuse me, a 55% chance of losing and a 45% chance of winning. The only way that that trade works out, in my personal opinion, is if I get this back off on the stock initially. Yes, maybe it has a little bounce and then it needs to continue to sell off. Will that happen? It might. But the original premise that the stock was not going to get back above that opening price is flawed. The stock did get above that price. It's been able to rally. It's got some pretty decent support. It's got this nice upward sloping trend line. I'm going to be bidding to buy that spread back. Why? My underlying premise was wrong. I have to admit when I'm wrong. So I'm going to right click. I'm going to click trade options. When I do that, Option Stalker opens right up to my position, and you can see it here. So I'm short these, so I'm going to click the ask. That's a buy order. And I'm going to sell those. That's a sell order. And right now you can see that the spread is 90-cent bid, offered at $1.10. So I'm going to be bidding for it. I don't know exactly where I'll buy the spread back right now. I am watching this upward sloping trend line on the stock. If the stock breaks below it, then I might hang on to the bearish call spread, but I'm going to close it down by the end of the day. There's no reason for me to take risk on this position. It hasn't done what I expected it to. I thought the stock would drift lower and lower and lower, fill this entire gap in. It's not happening. So I'll probably be able to make money on the trade, but I'm going to shut her down. And I thought that you could learn just as much from a trade that's not doing what I expected as you can for the trades that are winners. So I'm going to be shutting it down. This is a time to really reduce your risk exposure. The market's going to be flat. It's going to be choppy. Stocks that normally have a lot of volume are even going to start to get choppy. The bid-ask spreads on options are going to widen out. Reduce your size, reduce your trade count over the course of the next 10 days or so, right into year end. I hope this video helps you minimize some of your losing trades on your positions that aren't quite working out. Be disciplined, know when you are wrong, and shut the trade down and move on to the next trade and the next trade and the next trade, because there will always be great trades where you feel that the probability still remains extremely high. Thank you.